Hey guys, so I'm doing this video because there's a lot of talk about the 2-1 buy down. Now there's a 3-2-1 buy down. So what does that mean for you as a buyer? So that's why I'm doing this video. It's always easier when you look at numbers, when you get everything broken down. So here it goes. And I'll try to keep this video as short as possible. If you have any questions, you can always reach out to me at the end of the video. I'll give you my contact information so you can reach out and I can break down a specific scenario for you. So now let's say we're doing a $499,000 purchase. Your down payment is $24,950. Loan amount's $474 with $50. Now, this example was done a couple of weeks ago. So I'm using it just for illustration purposes. You'll understand the reasoning behind the loan. So the rate is not important. It's you understanding how the loan works and why it's such a big deal, especially right now that rates went up. So, okay, your interest rate on the loan would be 6.875. That is the rate that you would get qualified at, which is your qual rate. That's what this is called. Okay. So your qualification, how much you qualify for, your options, FHA, conventional. And by the way, guys, this loan can be done with VA, can be done with FHA, and can be done with conventional. The 3-2-1, which I will explain in a bit, is only for VA and FHA. So your rate is 6.875. That is what you're qualified at. But the first year, you get a 2% interest or payment relief or payment break. Thus the 2 and then the 1, because the second year you get 1. So pretty much 6.875 is your rate minus 2 for the first year. So your payment would be calculated using 4.875. Then year 2, your payment would be calculated at 5.875, which is minus 1. So year 1 is minus 2, year 2 is minus 1. That's why it's called the 2-1 buy down. What happens after year 2? You go back to your original interest rate, which is 6.875. Excuse my drawing, but I'm trying to make it as simple as possible for you guys to understand. So how is this possible? Or is this adjustable? That's one of the questions I keep getting asked. No, it's not. It's 100% fixed. You know, when you sign your loan docs, you know exactly what your payment's going to be. Year 1, you know exactly what your payment's going to be for year 2, and you know exactly what your payment's going to be for year 3 through 30. Your payment's not going to adjust. I know a lot of people, and I've been doing loans since '99. I saw people getting 2-year fixed loans back in 05, 06, 07. Then after the initial or the intro rate or intro payment, their interest rate and payment skyrocketed and they lost their house. This is completely different. This, beforehand. Why are lenders doing this? Because I don't know if you guys have seen the Rocket Mortgage commercials. They call it inflation buster loans. That's exactly what it is. Basically, banks, they know that current interest rates will not remain. Why? Because it will destroy the economy. So what they're doing is they're giving you the ability of going into or buying a house without having to pay the current interest rates. So they're basically giving you the ability to buy a house at a great price, because right now sellers are entertaining discounts, they're entertaining lowball offers, they're entertaining credits. So you can go into the house and basically make payments on on that house with a really good interest rate. Basically, what your interest rate is going to be, what they estimate your rate's going to be in a year. So now, what happens if interest rates go down, which they will? At that point, for example, if you got an FHA or VA loan, and let's say it's year one, you're about to go into the 5.875. So at that point, what you can do, it's called a streamline for FHA and VA IRRRL, interest rate reduction loan for VA, which basically just will lock in your rate, whatever the rate is. For example, let's say, and don't quote me on this, but rates are estimated to be at around the high fours, low fives. So let's say your rate is at 5.25. At that point, you can lock in that rate. The good thing about this is that now you have the house, because once rates go down, the way everybody's expecting them to go in next year, second quarter, guess what's going to happen? Everybody has been on the sidelines waiting for interest rates to come down are going to go and want to buy. The problem is we have a shortage problem. And by the way, this is not a real estate bubble. For those of you that are waiting for the bubble to burst, you're going to get burned, because this is a supply problem, not a real estate bubble. So nobody's selling, because think about it. Why would you sell your house that you secured a 2% interest rate and go and start paying 5%? So sellers are waiting. So that's creating a bigger problem. That's a conversation for another video. But now, how much is this going to cost you as a buyer? Nothing. Absolutely zero. Everything's paid for by the seller. So for example, in this case, for you, the buyer, to be able to do this, it's costing the seller, let me get another color here, it's costing the seller $10,985. So is that a bad thing? No, it's not, because like I mentioned, right now sellers they're desperate. Honestly, they are. They want to sell their house. It's sitting on the market. And for example, if you want to buy this house and you need closing cost credit, plus you need the buy down credit, at that point you'll need 3%. So let's say your sales price, let's round it off to 500. You need 3%. That's 15,000. Will they entertain it? If you have a good agent that knows how to negotiate, you probably will. Why wouldn't they give you a $15,000 credit as opposed to having to lower their listing price by $25,000, which is 5%? It's cheaper for them to give you a 3% credit. That way they can get rid of the property, they can lock it down and get rid of it. So right now it's not a time for amateur agents. That's why all those real estate agents that joined the industry during the good times, they're gone. They had to go look for another job, because right now agents have to earn their check. They have to go in there and fight for a good price, good credit. It's not just getting a good, because now you can lowball and get credit. So that's why right now, guys, if you're thinking of buying, this is the best time. Don't wait for rates to go down. So if you have a specific scenario, if you want me to refer you to a really good real estate agent that will go bad for you, that will get you a low price or lower price and the credit, so you can do this. Because remember, with the credit, you can get up to 6%, up to 6% credit. You can even get a 3-2-1 buy down, which will be another video that I will do next week. That way you understand what it is. But basically it's the same thing, but an extra year. It's just you'll need more credit, so it's a little bit more challenging. But this is possible right now. 75% of the loans that we're doing right now are with buy downs, and that is because the seller, the agent that's representing the buyers that we're doing loans for, they're actually going and getting this credit, not only getting the credit for the buy down, but also getting credit for closing costs. So if you have any questions, if you want me to elaborate or break everything down, I'm trying to keep the video as short as possible. I'm already going into 10 minutes. Give me a call, 619-948-2996. Or shoot me a direct message, and I'll be more than glad to break everything down for you personally. Talk to you soon.